Well, good afternoon, everyone. I'm Alex Thompson, the Head of Capital Markets for iPartners, and welcome to the iPartners Funds Update, where we'll aim to provide an update for our investors across each of the iPartners funds and across the broader iPartners business. So for those new to iPartners, we're one of Australia's leading alternative asset investment platforms, providing self-directed wholesale investors access to institutional grade alternatives. We offer our investors access to a range of alternative asset classes, including private credit, private equity, asset-backed debt, and private real estate. So investors have faced enormous challenges in the last year. And while the vaccine rollout and the economic recovery gives us cause for optimism, there's a lot of rebuilding ahead, and alternative investments have an important role to play. So as we begin, I'd like to welcome iPartners CEO Travis Miller and iPartners Head of Portfolio Management, William Wong. Travis has led the evolution of iPartners' private credit, private securitizations, and the funds management businesses, with a constant eye to the broader strategic direction and emerging opportunities for the platform. And Travis has worked in financial markets for more than 20 years, most recently as the Managing Director at UBS Investment Bank, and previously as a Director at Deutsche and ANZ Bank.
It's being recorded, right?
But William is a corporate finance and investment specialist with extensive and diverse experience in equity, credit and derivatives, having worked in capital markets across Sydney, London, Hong Kong, as well as Manila. William was formerly an executive director at Goldman Sachs, responsible for principal investments in illiquid assets, and commenced his career at PwC, where he was qualified as an actuary. So prior to today's session, we reached out to our investors and asked them to let us know what they'd like to hear more about, and we've incorporated those questions into today's session. If there are questions along the way, please submit them through the portal, and we'll have time for Q&A at the end of today's session. So our private markets opportunities aren't sourced on screens. They're originated from the relationships and from the networks of the iPartners team. The iPartners investment team reviews hundreds of opportunities each year, and it's only those opportunities which meet our investment charter and are approved by our investment committee, which are ultimately available for inclusion by the funds management team. iPartners Funds Management now offers investors access to 3 distinct investment strategies, each targeting a specific risk-return profile. The funds have been designed to provide investors access to actively managed, diversified portfolios of alternative assets, which can be used as a core holding in investors' portfolios. Our fund series include 2 defensive alternative strategies and 1 growth alternative strategies. Today, we're keen to talk in detail about all 3 funds, but before we do that, Travis, could you please give us a brief update for the iPartners business more broadly?
Sounds good. Thanks, Alex. I don't know if you can just click to that next slide. Thanks for that. Yeah, so as Alex mentioned, I think it is now very clear that iPartners is Australia's leading alternative investment platform. You know, a couple of years ago, we used to have a similar line in our pitch book, and I think it'd be quite, would have been arguable whether that was the case. But I think now, given the growth, of investors on our platform, now over 10,000 registered investors, over greater than $1.2 billion have been invested via the platform. Probably in a week's time, that'll be closer to $1.3 billion. So there's quite a lot of volume starting to go through the platform. And the reason I wanted to just highlight this at the start is, even though the investors are investing in the funds, I think it's important to know that you're investing with, a strong business that is growing, and it's going to be there in perpetuity to support, the fund and the performance. So there's actually been 190 different transactions go through the platform. From what we see on top of that, there's probably only 5 to 10% of transactions we see that actually get through to our investment committee for consideration. So we're looking at a large volume of transactions. The big part about the business as we grow, there's a heavy focus on governance and operations. So what we've been doing is growing the team, obviously focusing on stability of the team, because we've got a very high quality team, ex-investment bankers, ex-domestic bankers, and experienced fund administrators. But we've really been spending quite a lot of time and effort recruiting key people in the business, whether it's across sort of operations, legal, putting in place independent directors, and just beefing up the investment team. And Will's been here quite a while now, but obviously Will's a key prong to that business. If you want to just jump to that next slide, Alex. And then the next piece is just to understand why the iPartners funds management business even exists. So when we started, the primary goal of the business was to allow direct investors to access alternative assets. And the alternative assets were literally single asset underlying. So we're setting up funds so investors could access unique investments in increments they were happy investing in. But the natural progression from that was people started coming to us and saying, look, can I just give you a portion of money and you can just manage it for us on an active basis and build me a diversified portfolio, so I don't really have time to consider all your investments, or maybe I don't have the skills to do so. And so that's where the funds management business came about. We're past 2 years now of track record. It started with a private mandate in the private credit space, and then it went to effectively to the more diversified and public funds. So the first fund that we launched was the iPartners Investment Fund. As I mentioned, coming up towards 2 years of track record there. It targets a return of 8 to 10%. And it's been tracking in the high 9s across the duration of that period of time. So what we focus on there is literally transactions that get approved for our investment committee. We look at them and we look at what's the appropriate weighting to those. And we look across quite a diverse segment of the market, whether it's private credit being, corporate loans, asset-backed transaction where it's backed by a portfolio of different types of underlying assets and property. We also look at third-party funds. And the reason we look at third-party funds is that one of the biggest challenges in managing a private credit pool is cash drag in your portfolio can really drag down returns. So being able to invest in, other funds actually enhances both the liquidity and the performance of the underlying fund. So as I mentioned, the investment fund was the first one. What you're seeing on screen there was the second fund we launched, which was the Core Income Fund. And the Core Income Fund was just about for being slightly more conservative. So similar strategy to the investment fund. We had a few investors saying, well, I really like that fund, but I wouldn't like a little bit more sort of capital stability, a little bit higher liquidity. And we've said, fine, so let's look at this 6 to 8% target. And the key difference there is that we really just tend to look at more senior assets, so senior secured, whereas the investment fund might have more junior secured assets. But it's a very similar strategy, very similar investment team, investment committee, and we'll just look at what assets, the weighting that's appropriate for both of those underlying funds. And just going to that next slide, the last fund that we launched was the iPartners Growth Fund, again on the back of investor demand and the type of transactions we're seeing. Investors, with over 10,000 investors, people have different appetites. And we had investors saying, look, I wouldn't mind looking at the little bit higher growth end of the market. And that's when we launched this growth fund. And this is where we'll look to put things, so, junior secured assets from asset-backed transactions, private credit, so loans to companies, things like convertible bonds, where there's potentially a little bit of an equity kicker, where, equity aggregation type strategies where there's that potential coupon along the way and then potential equity kicker at a point in time. And so this fund's a little bit longer tenor, but we expect the performance of this fund as some of these equity upsides and assets are remarked over time, we'll expect that IRR will start to drift up. I've gone through some of that, relatively quickly. And as Alex mentioned, happy to answer questions at the end, but I just thought just a high level background on the business, why the funds management, business actually exists. But as I mentioned, happy to answer questions later, but I'll hand over to Will, who go through sort of more of the governance and what sits behind these funds.
Thank you, Travis. I can also go into a little bit more detail about the type of assets the funds invest in, and also the difference between the funds, which is two common questions that we get. On this slide here, we've set up the different types of assets and tried to show different type of allocations we have between them for the different funds. At the top, we have what we would call public market transactions. For our funds, we're focusing on alternative investments, and they tend to be private market transactions. Public transactions we can categorize as investment grade bonds and high yield bonds. These tend to be issued by larger size companies, and the issuances are in larger size. They tend to be more liquid, and the issuers are very well known. For that type of market, demand can be very high, and that results in quite low yielding assets. Investment grade bonds may be low single digit returns, and higher yielding bonds may be mid single digit returns. So moving into private type markets, these might be smaller type companies, smaller issuances. It means these transactions are more illiquid, and they may be negotiated, more complex type transactions. One of the benefits of private market transactions is we can seek to achieve higher returns for comparable risk. It doesn't mean the high returns reflect higher risk. It reflects partly illiquidity, the complexity in the transactions, and also the work required in assessing and structuring these deals. Within private credit, there's also different type of categories. Asset-backed is a large category for us. Asset-backed transactions are, you can compare to a mortgage. A bank will lend to a borrower with a loan secured by a house or a property. The primary credit is the borrower providing an ongoing servicing of the loan. But as a backup, there is an asset, which is a house which a bank could sell if required to provide support for that loan. That's one type of asset-backed security. Other types of assets can be cars, they can be financial assets, consumer loans, business loans. The extra support provided by the assets provides a very strong credit. And that's one of the reasons why the core fund in particular has a higher weighting to asset-backed transactions. Within asset-backed, there's also senior loans and junior loans. The difference here is in the event of having to enforce and sell the assets to protect the loan, the senior loan would get repaid first. And after the senior loan has been repaid, then the junior loan would be repaid afterwards. They will price differently. The senior one is a stronger credit. It will have a lower yield compared to the junior security. We invest in both. Both can be strong credits. They're just slightly different risk return profiles. Outside asset-backed, there are also what we call credit opportunities. These may be corporate unsecured loans. The companies may be performing very well. They have strong cash flows, strong growth profiles, and they can also represent strong credit opportunities. Outside private credit, we also have private equity. These are equity-like investments. They can be pre-IPO type funds. They might be preference shares. In particular, we'd be looking for preference shares that have a printed coupon with potential upside. So these are the type of private market transactions that we're looking at for our alternative investments. Now, what is the difference between the funds? The main difference between the funds is the different allocations between these type of assets into the funds. For example, in the core fund, there will be a higher weighting of asset-backed senior. In the investment fund, there may be an increased allocation to asset-backed junior securities and also credit opportunities. There may be some assets which are suitable for both the core fund and the investment fund. The difference there would be the core fund would take a higher allocation of asset-backed senior, and the investment fund would take a higher allocation of asset-backed junior, but they may invest in similar credits, although the allocation will be different. The core fund does have a slightly different strategy. Growth fund would take an increased amount of credit opportunities investments and also a higher weighting towards private equity-like assets. And maybe another difference between the funds is the distribution frequency. The core fund will have monthly distributions. Investment fund has quarterly distributions, and the growth fund will have annual distributions. So that's just give you an idea of the different type of the assets the funds invest in and the differences between the funds. So to the next slide. The way we work, we have a multi-layered and structured governance structure. At the group level, we have a group board and management. The group management isn't directly involved in the investments as such, but they do provide things like a code of conduct, a conflict of interest policy, a governance handbook that goes to all new joiners, and regular compliance training, which is mandatory for all staff. Separate to the group management, there is an independent trustee for the funds, comprising of 2 directors, Justin, who's a financial markets specialist, and Astrid, who's a financial markets lawyer and previously a partner at Baker McKenzie. The investment committee reviews all the major transactions for the funds and also for the platform. There are 4 members, includes the 2 managing directors, our chief operating officer, and our head of product. All the members of the investment committee have deep experience in financial markets, and they're reviewing these transactions in quite some detail. And it's more directly on the funds, there are 2 portfolio managers, Travis and myself are the ones selecting and managing the investments for the funds. A little bit on my own background, being one of the newer members of the team. I have a strong background in banking and lending. I originally qualified as an actuary at PricewaterhouseCoopers, originally in the project finance advisory team, before I went to work for a bank doing project finance, financing large-scale infrastructure projects. Infrastructure projects are things like power stations, gas pipelines, electricity transmission networks. My time in investment banking was at Goldman Sachs, executing principal investments in liquid assets. These were illiquid due to large size, typically billion-dollar deals, long tenor, 20, 30, 40-year type deals, or high complexity. And typically it was all 3. In more recent years, I have worked as an equity analyst in in-house corporate finance. And before coming back to Sydney last year, I was working for a fintech company responsible for capital markets. And this company was a B2B lender in the SME space in the Philippines. A very useful background given a lot of the transactions we have now are related to non-bank financial institutions. So that background it's been very helpful for me in this role, given we do a lot of detailed analysis, structuring, and execution for the transactions. On the next slide. What we aim to do in the funds is to generate superior returns. How do we do that? Firstly, we have highly skilled and experienced executives with deep expertise in financial markets and investments. We take a lot of time to understand the companies that we're assessing. We take the time to meet the management, review their financials. We want to understand the companies very well and to understand the investment opportunities that we have. This detailed analysis, I think, is something that stands us apart from some other teams where they might be just looking at the pricing or the very high level understandings of the company. One very strong advantage that we have for our funds is the proprietary deal flow that we have through iPartners. We have an in-house product team that works very closely with our corporate clients. This proprietary deal flow gives us access to investments which aren't available anywhere else, and also allows us to generate investments with superior returns. It's important to note that we have 2 sets of customers in our business. One is the investor and fund clients. And on the other side, we have our corporate clients. and they come to us to raise capital. And we provide them with a high valued service. There's a few things that we can do for them. One is we can understand their business better than others might be able to. We can structure transactions for them, which are bankable and also investable. And a third thing that we can do is we can execute very quickly. And this is an advantage that we have compared to, say, the bank market. Some of our clients may be able to obtain better terms in the bank market if they had 3 or 6 months to execute their transaction. But if they need to have something done quicker, that's something that we can deliver for them. And that service allows us to generate these products at a higher return. But the clients are happy to pay for that because of that service that we're providing to them. So those are the things that help us generate superior returns than, say, standard public market transactions. How has all of that translated into fund performance? For the core income funds, since inception, the return has been 7.42% per annum. That's in the top half of our target range, which is a pleasing result. And given the way the portfolio is set up, we expect that to continue. The investment fund, since inception, has delivered 9.68% per annum. Again, that's in the upper half of our target return profile. And given the way that portfolio is set up, we expect that type of return to continue as well. The growth fund, since inception, has delivered 11.16% per annum. This is at the lower end of the target range, and that's a function of the way we're designing this portfolio at the moment. The design is to seek yielding assets which will support the lower end of the range, but with equity upside and potential equity upside, which is inherent in the portfolio, which will crystallize over time. So we would expect that over time, that return to increase as this equity upside comes through. So that the portfolio is positioned well and it's developing pleasingly for us. The pipeline that we have continues to be strong. We're still executing. We're very busy even leading up into Christmas. We have a few mandates. These transactions are, one is a fleet lease financing, another one is a secured property financing. So with these coming through, coming down the line, they're still providing very good opportunities for the funds to invest in. So we think the current portfolio positioning is very good, and the pipeline is going to allow that to continue. I think with that, I'll pass back to Alex for any questions.
Oh, well, terrific. Well, thanks, Will. Well, and I'd like to invite investors to please submit any questions through the portal. We do have a few that have come through. This first one may be best for Travis. Travis, can you provide an example of an existing asset-backed lending opportunity?
Yeah, I mean, probably the best one to describe would be a group called Headstart. And they got some media in the AFR recently, and we've been working with them for about 4 years now. And I think that's, just to go through how we look at things, our starting point is always, what is the underlying credit? What does the portfolio contain? And that portfolio is a whole, hundreds of loans to parents of private school kids. And so most of them use those loans as effectively a line of credit, just to smooth private school fees over a period of time. And so we look at that credit. As far as consumer lending goes, it's a very, very high credit. But then on top of that, we then work to how do we get alignment of interest with the servicer, again, which is Headstart. And that's about ensuring that there's subordination or a first loss buffer built into the portfolio that is the appropriate size given the performance over time. And given across time we've been working with them, the buffer that's in place has been more than enough, to get comfortable with the underlying risk. And in that transaction, there's a junior loan, junior secured loan, and a senior secured loan. And I've gone through that very quick, but it's literally what is the underlying pool and what does that credit risk look like? And then on top of that is, how do we ensure there's a nice first loss buffer and alignment of interest with the servicer? Because you need the servicer to be ringing up mum and dad and saying, interest is due on your underlying loan and the principal's due back. So that's the servicer piece. And then it's really the documentation. Key thing about private markets is that you can have a great investment, great transaction, but unless your legal documentation is done correctly and you sort of dotted I's, crossed T's, things can go wrong purely from a documentation perspective, even if it's a good investment. So that's where, from the broader team perspective, where we've invested in people with those sort of skill sets, to ensure our transactions are documented correctly.
Great, thanks, Travis. Second question that's come through, are there any assets included in the funds not available on the iPartners platform?
There is at times. Yeah, there is at times. So if there's a certain asset that we'll do DD on, but the time frame is too short to get it in front of investors, or it's too small to justify putting it out in the platform, it'll go straight into the fund if it still passes our criteria. But a large proportion are always on the platform for direct investors, and our model is to ensure investors can choose single assets that they like or go into the fund, or a combination of both. But occasionally opportunistic trades for certain reasons will go straight into the funds.
Great. Next question. How do you work to preempt a macro environment that could potentially affect negatively the whole asset class, in particular defaults, say a recession or higher interest rates?
Yeah, so the primary protection is subordination from an equity perspective. So you need to size your first loss buffer in a way that it can survive through cycles. And so again, starting at the underlying credit, across a normal market, you might have a loss rate of say 1% coming through, but in a macro event, that loss rate might spike to 5, 6, 7%. We didn't see anything like that during COVID. In fact, most of our pools perform really nicely, but you have to size the transactions up front, considering all sorts of market cycles. And the number one protection you have, aside from maybe sort of equity on the balance sheet or cash on the balance sheet, is your loss protection that's factored in there up front. And that goes into, early discussion in our product team is, what is underlying risk? How much does this subordination need to be to put our investors in a nice risk return position?
Yeah, there are a number of protections in place. Another one is the relatively short tenor of the investments in the funds. Most of the investments will mature during 2022. That shorter tenor gives us a lot of protection against rises in interest rates and also inflation. And the other thing is some of these investments will actually benefit from higher inflation, given their underlying investments and the exposures that they have.
Great, thanks, Will. The next question that's come through, when specific single investment opportunities are put to investors, do the various funds also invest in these single opportunities? And for example, if invested in the funds and also invested in single opportunities, could investors be doubling up?
Yes, potentially they could be. But the protection in a way is that ideally we don't want greater than about 2.5% allocation to any single underlying asset. But for sure, there is overlap between the single assets on the platform and in the portfolio. Most investors that I talk to seem to use the funds business as a bit of a core holding. And then if they see an asset, a direct asset they quite like, they might allocate to that directly, taking into account that there is some of it probably in the fund, but they're increasing their weighting by taking on a direct position as well.
Yeah, great. And looks like the final question that's come through, can you please advise the current funds under management?
So we're approaching around 120 million on our actively managed. From a broader business, we're approaching around 900 million, and that includes sort of our single asset funds as well as our diversified business.
Oh, terrific. Well, look, thanks, Travis, and thanks, Will, and thank you for our investors for your support and for joining us at today's update. We certainly welcome any feedback on our strategies and in fact anything we've discussed over the session today. So as you've heard, we've designed the iPartners funds to provide investors access to diversified portfolios of alternative assets, which can be applied to various investor portfolios targeting specific risk and return, liquidity profile, and investment horizon specifications. All of the iPartners funds are available for monthly applications. To begin earning interest in our private credit funds from the 1st of December, please submit your orders through the platform prior to Friday, the 26th of November. Investors can participate in each fund from a minimum of $10,000 through the iPartners platform, although please reach out to your iPartners BDM or feel free to contact us at service@ipartners.com.au for more information. Thank you.